past 5 or 6 years, we've seen the world economy keep on dodging predicted disasters. That's continued in 2016, where we've seen a bounce in commodity prices, stabilization in China, and stronger growth across some emerging markets. Of course, the latest example has been Brexit, and what we've seen there is a lack of financial contagion across markets after the vote, and even in the Eurozone economy, very little impact after the Brexit vote. Of course, it's going to be tough for the UK, but that's quite a small economy. There'll always be risks, but we should remember there's going to be a policy response to try to limit the impact of those risks. The Fed seems to be quite comfortable with the external risks, and they also must be happy with the job growth they've seen in the past couple of months after the weak number in May. So the Fed is signalling rate hike before the end of the year. We think they'll probably go in December, and we think they'll go gradually over the next couple of years, so really nothing to be too troublesome for financial markets.
The hunt for yield is not over, but it is entering a new phase. Cautious investors should still look to have yield-dominated portfolios, but care should be taken in how this yield is accrued. Pick yield carefully. On the whole, the view has been taken so far that at the multi-asset level, some additional risk can be added to portfolios. The view is still to have a strong bias towards exposures that are income-driven. That has always been the case, and pose less risk than a full-blown pro-cyclical equity exposure. While equity valuations are challenging in the face of dull earnings growth, valuation metrics for credit markets look a lot less demanding. While credit valuations are not cheap in and of themselves, we think there are good reasons to be more inclined to pick yield from this source than equity markets. In most credit markets, the discount offered to investors over yields on government bonds is in the range of fair value. Selectivity is key. Many fixed income markets have been witness to very strong investor inflows. The point about picking yield is this: make sure any given bond is of sufficient quality to withstand at least some of the expected market volatility between now and the end of the year. Be willing to sacrifice some yield in return for safety. No amount of extra carry will compensate for owning an asset of dubious quality. Do not simply follow the crowd. Our equity allocation this month has not changed. We remain underweight Europe by about 3% overall, with market weightings in the rest of the allocation. We choose to add selectively across credit sectors in fixed income by reducing the overweight cash that we've had before from about 8% in the overall portfolio back to neutral, which is 5%, to add yield to portfolios on a selective basis in investment grade bonds as well as emerging markets and high yield by 1% each.